Bear case, of course, revolves back to valuations, which are certainly elevated. Bearish case also talks about the issues of overhype in the markets. We have just a lot of speculative extensions in the markets that are not necessarily great forward indicators of positive returns next year. But one of them, the 3-year price return of the markets. Again, we've had just exceptionally strong years for the last 2 years, and this will be a third year. But if we crank out another 17, 18, 19, 20% return year, that will be 3 in a row. Historically speaking, we are very deviated from the long-term moving average. Just from price returns, etc., that also suggests some risk to the outlook for 2026. Price reversion to the mean is one of the most powerful forces in the markets. And again, just when you get extremely extended from long-term moving averages, those averages are going to eventually pull you back. Something will happen and you'll get a reversion back towards the mean. So from just a purely technical basis, next year, something certainly worth looking at. Valuations, as I said, are extremely elevated, and those valuations also weigh on outlooks, because when valuations are extremely elevated where they are now, that's a function that ultimately you're going to have a reversal in the markets, because again, all it takes is something that says, remember that valuations are nothing more than a measure of sentiment in the near term. Everybody's very bullish on the markets right now, where they're willing to overpay for assets on both a forward and trailing basis because they expect that markets will continue higher next year. So why not? If I'm going to continue to get earnings growth and I'm willing to overpay for that earnings because earnings will catch up to what I'm overpaying for, I'll keep doing that as long as markets are rising. At some point, the valuations become problematic, because if there's anything that comes along next year that all of a sudden reduces forward earnings outlooks, then those valuations, what I'm paying for those earnings today, will have to be repriced. In other words, if I was going to make $100 a share this year, I'm willing to overpay for that. But if it's only going to turn out to be 80, I've got to adjust that valuation. But again, valuations are important because that's a measure of sentiment. And when the sentiment changes relative to what expectations are, that poses a risk to markets, because markets will have to be repriced ultimately for a new version of what valuations may look like. Also, too, we're starting to see one of the things that really hasn't shown up a lot yet, but I think is going to, is stress in the private credit markets. There is so much money piling into private equity, private credit. Wall Street's trying to push private equity and private credit into your 401k plan because they need to offload this stuff to somebody. That's how they make their money. That's one of the things that will impact the markets as a credit-related event. So there's risk.
Catch me daily on The Real Investment Show. The link is in the description.